Have you ever come across the term private equity but weren't quite sure what it meant? You're not alone. Private equity can seem like a complex world reserved for Wall Street wizards. But fear not, because in today's video, we'll break down what private equity actually does and how it impacts businesses and the economy. What is private equity? Imagine a group of wealthy investors pooling their money to buy businesses. That's the basic idea behind private equity. These investors, often through private equity firms, invest in companies that are not publicly traded on stock exchanges. And like publicly traded companies, private equity firms typically hold onto these businesses for a specific period, aiming to improve their performance and ultimately sell them for a profit. So, how does it work? Private equity firms raise money from various sources, including pension funds, insurance companies, and wealthy individuals. This pooled money forms a private equity fund. The firm then uses this fund to acquire companies that have the potential for growth. Here's a simplified breakdown of the process. Fundraising: the private equity firm raises money from investors and sets a specific time frame, usually 3 to 7 years, to invest the funds and generate returns. Acquisition: the firm identifies and acquires companies with promising growth potential. This might involve using debt financing, borrowing money alongside the equity raised from investors. Value creation: once acquired, the private equity firm actively works with the company's management to improve its operations, increase profitability, and ultimately enhance its value. Strategies might include cost-cutting measures, expanding into new markets, or improving product offerings. Exit: after a specific period, the private equity firm aims to exit its investment, typically by selling the company at a significant profit to another company, a strategic buy, or by taking the company public through an initial public offering (IPO). What's the benefit? Private equity plays a vital role in the economy by providing companies with access to capital for growth. Growth funding: private equity firms can provide funding for companies that might not qualify for traditional bank loans or struggle to raise capital through the public markets. This allows businesses to expand, innovate, and create jobs. Operational expertise: private equity firms often bring in experienced professionals who can help improve the company's management and operations, leading to increased efficiency and profitability. Focus on long-term growth: unlike public companies with a constant pressure to deliver quarterly results, private equity firms can take a longer-term view, focusing on strategies that generate sustainable growth over a several-year period. Are there any drawbacks? While private equity offers benefits, there are also potential drawbacks. Focus on short-term gains: in some cases, the focus on maximizing profits for an exit within a specific time frame might lead to cost-cutting measures that can negatively impact employees or the long-term health of the company. Increased debt levels: private equity firms often use a significant amount of debt to finance acquisitions. This can put a strain on the company's finances if the turnaround plan doesn't succeed. Limited transparency: since private equity deals involve non-publicly traded companies, there's less transparency compared to publicly traded companies. The global landscape of private equity. Private equity is a global phenomenon, with activity happening in major economies like the US, UK, Canada, and Australia. According to a 2023 report by EY, global private equity deal value reached a record high in 2022, driven by factors like low interest rates and strong investor appetite. Here's a quick snapshot of private equity activity in some key regions. US. The US remains the world's largest private equity market, with a significant focus on technology, healthcare, and consumer sectors. Europe. The European private equity market is also growing, with activity concentrated in major economies like the UK, France, and Germany. Canada. The Canadian private equity market is smaller but active, with a focus on sectors like natural resources, industrials, and technology. Australia. The Australian private equity market is experiencing growth, with a focus on infrastructure, healthcare, and consumer sectors. The future of private equity is expected to remain a significant player in the global financial landscape. As technology continues to evolve and new industries emerge, private equity firms are likely to adapt their strategies to capitalize on new opportunities. Private equity plays a complex but crucial role in the global economy. By providing growth capital and operational expertise, private equity firms can help businesses thrive. However, it's important to acknowledge potential drawbacks and ensure a balance between short-term gains and long-term sustainability. As an individual, understanding private equity can help you make informed decisions about your investments, particularly if you participate in pension plans or other investment vehicles that might have exposure to private equity funds. So, the next time you hear the term private equity, you'll be well equipped to understand its role in the financial world and its impact on businesses and the economy. Thanks for joining me today. If you found this video informative, be sure to like and subscribe for more content on the world of finance and investing. Let me know in the comments below if you have any questions about private equity or any other financial topics you'd like me to explore.